Welcome to the Chrisman Commentary, Daily Mortgage News Podcast. I'm your host, Robbie Chrisman. Topics on today's episode include the 50-year mortgage, my interview with Optimal Blue's Vimi Vasudeva on recapture strategy, why borrower retention is more critical than ever, and how lenders can model and price for recapture success. And with the lack of government news, place your bets on which direction rates will go. Do you know that TransUnion offers business-to-business solutions designed to address the unique needs of businesses across multiple industries? Mortgage lenders choose TransUnion for their identity-focused, data-driven mortgage insights and solutions, enabling them to achieve a more desirable lending outcome in a volatile housing market. To learn more, visit transunion.com. Affordability problems aren't just the result of rates and prices that are set by markets. What about taxes and insurance? What about condo fees and special assessments? What about city and county fees? Extending the maturity of a mortgage isn't going to help someone who can't find insurance for their home or just received a $40,000 assessment for replacing rebar. If you can defer amortization, you won't grow wealth or save as fast, but you may help a bit with monthly affordability. The Trump administration is working on a 50-year mortgage in an attempt to boost affordability. How much would a 50-year mortgage matter? Probably not much. Assuming the rate difference between a 30-year and a 50-year is not that much, that's a big assumption, of course, the difference in mortgage payment would be about 11% lower for the 50-year product. Most 30-year mortgages never last 30 years. The typical life is something like 7 to 10 years, so going to a 50-year mortgage probably won't change that. Borrowers are exchanging lower monthly payments for lower equity when they sell the property. In a market with decent home price appreciation, this isn't an issue. In a market with flat housing prices, borrowers will have to hope for enough home price appreciation to cover closing costs if they have to move. For what it's worth, this was the case in the early 80s when mortgage rates were in the teens. The first few years of the mortgage went almost entirely to interest. At first glance, longer seems attractive because payments are stretched. However, once you factor in the investor's perspective, the rate would likely offset any borrower benefit. The lower the term of a mortgage, the faster an investor can recoup capital, which is a big reason why a 15-year is priced better than a 30-year. It's more appealing to investors. The longer the mortgage, the higher the risk of delinquency and life event-related factors. This would have to be priced in. And longer mortgage terms deal with impacts of inflation. The time value of money goes down, and there's no secondary market for the 50-year today, and it would likely take a long time to create enough liquidity to make an efficient market. For today's interview, we wanted to welcome to the show Optimal Blue's Vimi Vasudeva to talk about recapture strategy, why borrower retention is more critical than ever, and how lenders can model and price for recapture success. She's Managing Director of Hedging and Trading Client Services at Optimal Blue, where she manages a team of account managers who service and advise pipeline hedging and risk management clients and mortgage servicing right valuation clients, including several top industry originators and servicers.
The dust has settled a little bit from MBA Annual, which I had a great time swinging by the Optimal Blue meeting room and seeing Olivia and Alex, and I saw Sarah in the hallway. You were there as well. You were a panelist on a session focused on recapture strategy, which is so huge right now. We can't overstate just how big of a strategic play it is for almost everybody involved in the mortgage industry. Getting to borrowers early to recapture them, being that first touch point, that sort of thing. Why do you feel like the topic is so important?
I think the recapture topic is so pervasive because we're in an unprecedented time with respect to recapture challenges and opportunities, given that many variables are at play right now that could impact recapture. There's a fundamental shift in the marketplace as we see large servicers becoming even larger via acquisition. We're seeing our first meaningful downward rate shift in about a year. And finally, and most recently, I think it's because of the passing of the Homebuyers Privacy Protection Act, also known as the Trigger Leads Bill. What this bill does is prevent the credit agencies from selling borrower data as credit inquiries are made. Banning trigger leads will negatively impact recapture opportunities for those that purchased and relied on the trigger leads. And then, of course, on the other side, this ban will likely make recapture for existing servicers even more successful. Specifically to this topic being one at the MBA, I think the NBA really wanted to highlight, and rightfully so, their success as they played a critical role in getting this bill passed. So on the panel with me was the VP of Legislative Affairs from the NBA, who really highlighted the purpose and the history behind this bill.
And some big takeaways from the panel for you, some insights to kind of open your eyes that maybe you weren't thinking about before you were up there.
It was really interesting even just to understand the history. I mean, I think a lot of us who are paying attention to mortgage news are all very aware of the trigger leads bill. I don't know if many people understood the extent to which the prospective borrowers were being bombarded. So there was a really interesting anecdote that she started with, which is a former MBA member was in the home buying process, and she had received 221 text messages or phone calls that she did not sign up for. And I think that it causes a lot of stress to an already stressful situation that someone is dealing with when there's so much to consider in the home buying process.
What's Optimal Blue's perspective on this topic? Obviously, they're an integral player when it comes to a ton of kind of the machinations driving strategies for originators out there.
Optimal Blue is committed to supporting recapture so much so that we've invested in multiple recapture tools to help both originators and servicers of all sizes. As we've deployed these tools, we've focused on what we think are the two most critical components of a successful recapture tool, which are automation and accuracy. With automation, it's how you scale the loan officer's relationship to their many borrowers. Make it easy for the loan officer, but also make it meaningful for the borrower. Originators should be leveraging tools that automatically scan a portfolio or lead database and identify borrowers with the highest propensity to refinance. But the information that's provided in that communication is just as paramount. You want to strive for accuracy at that first point of contact with the borrower. It's not sufficient to say that the Freddie survey or the OBMMI is at X rate level. You need to approach the borrower with the most dialed in offer as possible. Our tools allow loan officers to seamlessly provide highly stylized personal offers based on your entity's pricing and provides actual savings in dollars based on these offers. The worst thing that could happen is you approach a borrower with a 5 7/8 simply because that's what market is quoting. But the economics are such that the rate is actually a 6 3/8. So now you've upset the borrower, lost credibility, and that's where the need to be integrated with a robust PPE comes into play. The level of granularity a PPE, such as ours at Optimal Blue, empowers your sales force to chase the most compelling leads and back up the refinance solicitation to the borrower with actual numbers as to how much the borrower could save in monthly payments.
Let's talk about the different sized lenders here. If you're looking at a small lender versus a medium sized one versus a large one, how should lenders of different sizes be thinking about retention or recapture opportunities?
That's a very complicated question because each lender will have a different answer to this depending on their focus, their priorities, and their technological capabilities. But one trend that we generally see with respect to the hundreds of lenders that we cover at Optimal Blue is that smaller lenders are less likely to fully capitalize or recognize the value of recapture into their MSR valuation assumptions. This is certainly a more conservative approach, whereas a more aggressive approach employed by a few larger aggregators or servicing buyers is to price the recapture value more fully into their bid. And so, what this means in practice is that it's often difficult for smaller lenders to justify retaining the MSR. Because if you think about it, the opportunity cost of doing so is basically that extra value that larger aggregators and servicers are able to extract from the MSR, resulting in that increased scale and recapture capabilities. But again, it's not to say it's impossible for smaller lenders to incorporate a recapture strategy. One of the benefits of improvements in technology is that smaller lenders are now, more than ever, I would say, better able to compete with the bigger players. So again, low-cost tools and technology to source recapture leads are widely available. As we've developed these tools at Optimal Blue, we've been at a really great advantage of putting sophisticated and accurate solutions out there. because what's important in any effective recapture tool is going to be about automation and accuracy.
And I don't want to belabor the point too much here, but I do want to talk about the link between recapture and front end pricing. For people that aren't intimately involved on the servicing side of things or on the capital markets side of things, how should they think about how recapture strategies change front end pricing that's shown to borrowers?
And that's such an important point. So I'm glad that you asked that, Robbie. Anecdotally, I've heard that the passing of the bill, for example, could increase retention for servicers by up to 20%. So it's also worth noting that what this means from a dollar or basis point value perspective is that the increase in retention would ultimately impact the rates that borrowers see if the servicers that are able to recapture at this rate are including that value in the front end pricing. And so we actually were able to model out what this impact could look like by using the Optimal Blue MSR cash flow engine that allows you to model out a value for recapture, among many other sophisticated analyses, of course, given that the platform is used to value about 70% of servicing that's out there. But in a case where we held all other variables constant and we increased retention by 20%, we actually saw a 5 basis point increase in MSR value, which then has that downstream impact of 5 more basis points that could go into front end pricing.
Right now, it's becoming more and more timely because I think mortgage rates, conventional 30-year rates are about half a percentage point below where they were a year ago. And so we're getting toward that historical cusp of 3/4 of a percentage point where it starts making a lot of refinance sense, or it starts making a lot of sense for borrowers to refinance. And so this is super timely. It's super important. Any planning considerations that you think are important for refinance or lower rate environments?
I think that lenders need to be very, very strategic. Again, given how competitive it's going to be, that lenders will certainly want to target high propensity borrowers. So the borrowers that are most likely to refinance based on the standard reasons, right? Interest rate differentials, loan anniversaries, home equity growth, and so on. There are predictive analytics out there to help with this. And the strategy ensures that servicers are prioritizing outreach to borrowers with the highest risk of prepaying, thereby improving their retention and reducing runoff. And I think that it's important to manage capacity too. So monitor internal benchmarks for closing timelines. For example, how long does it take to move from lock to underwriting to close? It's important to keep tabs on your internal capacity. You don't want your LOs to pursue recapture opportunities and get ahead of themselves and then create internal bottlenecks that'll cause a bad borrower experience and elongated closing timelines.
What else is Optimal Blue focused on right now? I know that's probably greedy of me to ask that question because there's so much y'all are doing, and I see y'all everywhere. But anything else you think's a focus that would be good for listeners to hear today?
Yes, we are thrilled to be planning our 2026 Optimal Blue Summit, which will be February 23rd to the 25th in Scottsdale. If you're an Optimal Blue client, that's the best place to be the first to hear about all of our new innovations. And we're working on some very exciting things. We're taking feedback from our last summit, and we're even adding a day of more hands-on training. And I'm personally very excited to let everyone know that there will be a day dedicated to MSR training, since that's my baby at Optimal Blue.
Yeah, that is exciting. And I went to the inaugural summit earlier this year in San Diego and had an excellent time. I thought the sessions were great. I thought the keynote speaker Tony Hawk was really cool to see him up there with Mr. Tyrell chopping it up on stage. And so I'm looking forward to Scottsdale already. This should be fun.
Oh, we're so glad that you can make it, Robbie.
I'm certainly excited. I had a pleasure talking with you today, and hopefully we'll have you back on the show soon.
Yeah, thank you so much for having me, Robbie.
U.S. Treasuries began the week dropping in price and rising in rate amid optimism that the government shutdown will soon end. The 30-year yield briefly retested last week's highs before easing back to flat levels, supported by a solid $58 billion 3-year note auction. With markets closed for Veterans Day, focus now shifts to midweek supply, including a $42 billion 10-year note sale tomorrow and a $25 billion 30-year bond auction on Thursday. Despite all the talk of an imminent end to the government shutdown, the October Consumer Price Index will not be published, a first in the price index's history. Other critical economic releases scheduled for this week, including the Producer Price Index and retail trade reports, are also unlikely to be published, as most employees of the statistical agencies were furloughed in October. The bond market is closed today due to the Veterans Day holiday, but the calendar is not totally empty, as the NFIB will release its Small Business Optimism Index for October, and Fed Governor Barr will deliver remarks. Let's wrap up with a reminder and some housekeeping. Today is Veterans Day, so I encourage you to get out there and thank a veteran for all that they've done for this country. Thanks again to today's podcast sponsor, TransUnion. Mortgage lenders choose TransUnion for their identity-focused, data-driven mortgage insights and solutions, enabling them to achieve more desirable lending outcomes in a volatile housing market. To learn more, visit transunion.com.